About natural rubber. Natural rubber is a necessity for daily usage, and it keeps the world moving. It is used in a whole variety of products that we touch and use on a daily basis, right? So as you can see in the chart, 71% of the natural rubber usage is go towards tires, right? Tires, and the rest, the 30% of it goes towards the production of deep products such as gloves, condoms, and all the gaskets, all those things that we use in machineries, as well as road infrastructure building, etc. So globally, we consume about 14 million metric tons of rubber per annum, right? So and out of this 14 million, as I mentioned, the makeup is 2/3 to tires and 1/3 to non-tire. And natural rubber, it is sourced from a tree. The tree clone's name is called Hevea brasiliensis, right? And it originated, as the name suggests, it originated from Brazil since the 18,000 era, right? So out of this 14 million metric tons of natural rubber, 85% of it actually comes from smallholders, which we will explain later in the subsequent slides. The smallholder farmers are all individual farmers that owns and operates a small plantation each, and then they supply to the natural rubber producer such as us. So with the entrenched usage in the tire application, as well as all the deep products, which also powers the machinery in the cars and vehicles, naturally, natural rubber is a product that thrives on the global economic growth and, of course, the global mobility. And naturally, with the continued expected growth in GDP, global GDP, the natural rubber consumption is only expected to continue growing. Next. So we prepared this slide because a lot of people ask during our roadshows and also our discussions that they are asking what is the difference between the natural rubber and synthetic rubber, right? And whether one can substitute another. Contrary to what many may think, natural rubber and synthetic rubber are not direct substitute to each other. Natural rubber comes from an organic source, which is from trees, which I mentioned earlier, whereas synthetic rubber is an oil derivative. It comes from crude oil. So naturally, natural rubber is an organic product, and therefore it possesses more distinctive properties such as tensile strength and higher resistance to wear, and most importantly, it is bio-based, it is organic, and it is sustainable. And furthermore, in high performance use cases, we actually see a higher percentage of natural rubber content being used. If you refer to the right chart, you can see that actually in truck tires, which are significantly heavier than passenger tires, the natural rubber usage is actually higher in truck tires. For context, passenger tires it weighs around 5 kg on average, whereas truck tires can weigh up to 100 kg, 100 kg per tire. So for that, the natural rubber usage is the percentage is more because it is of high performance use case. So for commercial same goes to commercial vehicles and aircraft tires. It has higher natural rubber content because its usage is significantly more intensive. Next page, please. So after a bit of introduction about the business, the industry, I will touch a bit about Halcyon Agri. Halcyon Agri, we call ourselves a supply chain manager with high ESG standards, and we are present globally. you can see from the right chart, we are present globally, and we present along the supply chain, all the way from upstream, which is the plantations, and all the way to the downstream, which is the distribution of such products to the customers, to our customers. So we have capabilities, production and sourcing capabilities of where the rubber is sourced. As you can see, as you can see from the chart, the blue dots and the green green dots, they are along the equator where the rubber is grown, right? And we have distribution offices at the northern hemisphere, which is in Europe, US, China, as well as Singapore, to actually cover the whole world with our supply chain network, from all the way from the sourcing all the way to the distribution, right? So that's why we call ourselves a supply chain manager, right? So we have a factory in Indonesia that can produce both natural rubber and latex, and also we have a latex tank in the Netherlands that allows us to supply the products, the natural latex, on a just in case basis rather than a just in time basis, which is what is now the prominent theme. Some quick stats: we have 40,000 planted areas across the Africa and Malaysia. We have 37 factories globally with 1.4 million capacity, and we are present in 100 plus locations locally. And in Halcyon Agri, sustainability is our core business tenet. Next. So our business is broken down into two major segments. One is a Halcyon Rubber Company, and another one is Corrie MacColl, which I will touch later. So in this chart, I would like to provide a bit of introduction about Halcyon Rubber Company. So Halcyon Rubber Company is a preeminent tire-grade rubber supplier, and it serves predominantly the tire making industry, both internationally as well as in China. Some customer names that we serve. The international tire majors are the likes of Michelin, Continental, Goodyear, Sumitomo, etc. Whereas for China, we serve the the Chinese tire makers such as Alias, Hangzhou Zhongce, and the like of these customers. So our customer network is very extensive, right? So I would like to move your attention to the bottom part of this chart, as I wanted to explain a bit about the production process of the natural rubber, right? So we buy our raw materials from farmers. The farmers, what happens is that they will tap every morning, collect in the midday, and then they will truck their rubber to our factory to be sold to the factory, and then the factory will put the raw materials, which we call cup lumps, through a conversion process, which includes cutting, washing, and as well as mixing, as well as drying it to produce what we call tire grade technically specified rubber, TSR, right? So our production process is based on this standard called Hevia Pro, and annually our factories will go through a process of what we call a Hevia Pro certification, where it needs to comply to certain requirements which are relevant to the tire makers needs and requirements in their processes. And at the end of the day, we HRC site the factories once the rubber is produced individually, 35 kg block. We sell in a container of 1 metric ton each. This will then delivered to the global tire manufacturers for their further processing. Next page, please. Corrie MacColl. Corrie MacColl, we have two major business units here. We have two sub-business units under Corrie MacColl. Corrie MacColl is focused predominantly on non-tire and latex business. And it is integrated from upstream, which we have plantation, all the way to downstream, right? And we have the capability to produce 100% traceable natural latex, which means from tree all the way to the customer factory. So firstly, we'll talk about CMC Plantation. CMC Plantation is one of the world's largest, we are one of the world's largest owner of a commercially operated plantation globally. And we have land concession of 100 over 1,000 hectares. And we practice low density planting, which we have about 30% planted only. 30% of the land planted only, because it allows maximum yields and also due to ESG considerations. And speaking of ESG, our Cameroon business is the crown jewel of our ESG activities and our achievements. Moving along to Corrie MacColl International. CMC International is the outlet. Is the outlet for our plantation rubber. So our plantation, the latex, it will get delivered to the customers through CMC International as conduit. So that's the first function. Second function is that they serve as a supply chain partner of our customers, which sources from third party in Southeast Asia, or as well as Southern Latin America region, and then they supply to the customers at Europe and US mainly, right? So we have, as I mentioned earlier, we have the storage capability, warehouses and tanks at strategic locations, and that allows the customers to buy as and when they need it, rather than on an immediate basis, rather than having lead time for delivery from the Southeast Asian region. Next page, please. Some quick stats about the company. So about our market leadership position. So in 2021, we delivered 1.4 million metric tons of volume, and our market share is about 10% in terms of tire and non-tire combined. But if we zoom into just tires, we have a slightly more, 11% market share.
I will then next focus on probably the macro part of it, where do we see the macro, and also how do we position ourselves as a company in the bigger environment. So I'll probably go to the next page. I'll come back to this later. So I'll go to the next page on this natural rubber outlook. So I'll start with the left, basically some historical in terms of how the prices, natural rubber prices, have actually evolved in the last 20 years. So we can see on the graph on the left, the price actually peaked to about 5,000 to 6,000 in 2011, and subsequently it actually go down. It actually trending down all the way to 2016. A small run in 2017 to about 2,000, but subsequently it actually reduced or stays stagnant around 1,500 to 2,000. And during COVID time, we see that in the mid of 2020, we see that actually dip further to close to about 1,000 ton, 1,000 ton per 1,000 per metric ton. Subsequent to the peak in Q2, end of Q2 2020, the world commodities, I think, recovers, and we actually take the right of that. And you can see the price actually slowly actually inching up all the way to close to about 2,000, peak in 2021, and subsequently it actually rests around 1,006, 1,008 range from 2021 to 2022. Having said that, I think all of us are aware that the commodity prices for all other the commodity prices in general have actually gone up very significantly, especially for oil and also for oil palm. Notwithstanding, the oil palm is now actually moving down back to the price level as beginning of the year. Having said that, we do not actually see a very big surge in terms of price for rubber as compared to other commodities. At the same time, as we now experience the price of other commodities that's trending down, the price for natural rubber remains quite steady, I would say. So if we look at the overall trend, the Super Bull that actually run for almost like 10 years since the last round, from 2000 to 2011. Now we are at 2022. Indeed, I think there's sort of an overdue of a bull run that we actually expected for natural rubber, which is due to materialize. So that's our internal view. That's what I want to cover on rubber prices. And on the right, I would like to actually look at the consumptions in the next 10 years. So based on the study that we have, the consumptions is actually going to outpace the supply, and the consumption growth is likely to actually trend around 2.9 CAGR, whereas the production's growth is actually trending about 2.6 CAGR. So that basically means that at the point where we're speaking today, the consumption is actually slightly higher than the production's growth. And that's likely to actually merge roughly around the year of 2026 onwards 2030. And if I were to actually supplement in the next slides, please, we can see that there are a few positive factors in terms of the demand from a demand perspective. So we all know the world vehicle numbers have actually increased year-on-year basis, notwithstanding in 2020 because of COVID. But on a historical trend from ISRG report, we actually see that the number of vehicles actually grow at a rate of about 2%. And indeed, this is expected for the next 10 years as well. And I think what is also important is that the government, policy across major countries like US, India, China, they are very bullish about the infrastructure. The fiscal spending on infrastructure is significant, and that is actually expected to hit about 6 trillion by the year of 2030. So that basically means that there will be more roads that's being built across all these major economies, and as such, the increase in the numbers of vehicles is not difficult to actually estimate. So we are actually expecting that to actually give a very big boost in terms of the sales of tires, and thus translate to natural rubber as the number of demand for vehicles actually go up. And also the emergence of EV. All of us, I think, again, the government policy is very, very supportive of, is very conducive for EV growth in most of the country, and that actually accelerate the replacements of vehicle now, I will say, to replace the traditional ICE engines now to EV. And also at the same time, EV actually consume rubber faster or tire faster as compared to ICE. The reason for that is because they have a high torque as compared to the ICE. So in general, that actually shortened the life of normal tires by about 1/3 or close between 1/2 to 1/3. So I think that's basically explain the view in terms of the vehicles numbers on the left, and on the right, we also actually see that the change in the way the vehicles being used. Is conventionally we actually look at it from a personal ownership perspective, i.e. personal ownership miles. So what we're actually looking at that is basically I own a car, I drive a car to work, I drive my car to wherever, travel, etc. So there's a very conventional way of how we actually measure the miles travel. Having said that, in 2020, we see that especially with the COVID that actually hit us in 2020, we actually see there are different parameters that we are actually using to measure the miles that's being traveled. We call it mile as a service, mobility as a service, miles travel. So technically, what it means is that this actually widen the miles. I mean, the increase in the miles travel have actually widened as compared to the personal ownership miles, and that's actually driven by higher higher logistic because of online shopping, and also because of vehicle sharing scheme like Grab, Gojek, etc., Uber in the US. So in a way, vehicles are actually put on the road to run more often than it was previously, because the ownership of the vehicle is now not so much just tagged to personal, but most of it actually been shared. So with that, miles travel increase, that will tear up compared to conventional ownership miles. We also expect the demand for the replacement tire to actually increase at the same time. And indeed, if we go back to the earlier slides that Brendan explained, two-thirds of natural rubber is actually used for tires, and indeed of that two-thirds, another within the two-thirds of that is actually a demand for replacement tire, and one-third is actually OEM. So that is also actually driving up. That will actually definitely give a very big boost in terms of the use or consumption of natural rubber for us in the next probably 10-15 years. So if I were to move to the next slides, looking at the supply perspective. So this chart on the left actually shows the number of trees, new plantings in the rubber trees in the last 10 years. As you can see, there's heavy planting in the year 2009 to 2012. And you recall the first slides that I went through is basically the price of the rubber. It actually peaked around 2010. So it's not difficult to actually imagine everyone will flock to actually go and plant rubber. But having said that, the price actually reduced subsequently, and you can see correspondingly the new hectares or replanting or new planting have actually gone down throughout the year, and it's almost go down to new in 2020 as we speak. So as the natural rubber actually, the rubber tree actually took about 6-7 years to actually mature. So technically you have 6-7 years of gestation, no income, no yield that you can actually expect. So in order to actually replenish the supply, it will take another 6-7 years to actually patch back the shortage if there's a supply shortage in the market. So comparing the demand and so the supply, I think from general economy, it's not difficult to understand that there's definitely a price pressure, an upward price pressure in terms of natural rubber that we would expect in not if not in the short term, at least in the medium term to come. So in terms of other things that we are doing, there are other long-term trends that we think that they're actually favoring the natural rubber players like us. One is sustainability. So everyone is actually talking about sustainability. It's a big topic. Even in natural rubber, we are looking at savings in consumptions of energy, savings in consumptions of water, traceability of sources of the material that we actually got from. So that is actually, as what Brendan mentioned earlier, is one of the key tenet for us actually that we actually focus on. And also we also go into digitalization. I'll share more of that later in the slides to come. And also for non-tire demand, especially after COVID, we know the number of the consumption of gloves actually exploded. Right, the glove manufacturers have actually making a lot of money in the past 2 years. Of course, not now, but we actually see the demand for this kind of a product will continue to at least higher as compared to pre-COVID level. And moving next. So where we are in terms of position. So I think first we have a strategic location, geographic locations in terms of where we actually source our material. So along the equator belt, we actually operate in all the regions where we are having the advantage of a real-time resource or real-time raw material prices that is available around the world. So I think that gives us a very key advantage in terms of how we actually balance our cost of raw material. Second part is on the approvals on tire majors. We have almost all the approval. We have actually all the approvals on tire majors. And indeed, in order for us for natural rubber producer to sell the tire majors, we need to go through a period of about 12-18 months of approval process with tire majors, and we indeed for all the factories, for all the 38 factories that we have almost all the approvals from the tire majors. And sustainability, I spoke about it in terms of digitalization. I'll speak a little bit more later. And also the upcycle that probably we can actually expect in the if not in short but medium term to come, right? And moving on to the next slides, basically that's basically the assets that we have, the capability that we have across the world that I've actually explained, or Brendan have also introduced earlier. I will not actually spend much time about it on these slides. And in these slides, these are basically the tire majors, the main tire majors that we have actually got the approval. Names, I think these names are not unfamiliar to all of you. And on sustainability perspective, we are doing sustainability. At the same time, we are also getting third-party certification and recognition, and the like of EcoVadis Sport. Those are the key the key names that probably you are familiar with. They have actually given the attestation in terms of what we have been doing in the space of sustainability. And of course, one of the key important thing that we also have in our policies is zero deforestation. So we actually we have actually stopped we have actually implemented zero deforestation policy back in 2018. And what we will do is we will continue to actually replant for the area that we have actually planted for the rubber trees in our plantation in Cameroon. So that basically means that the old trees will, when it's not economical for us to continue to tap, we will do a replanting of that, but we will not explore further areas than what was being planted as we speak as at the state where we have in 2019. So yeah, moving next on the next slides. So on the plantation, I think one of the opportunities that I would like to also mention is that the plantation, we have 100,000 hectares of our plantation, about 35%, 35% of that has been planted. And of this area that's being planted, there are roughly slightly more than half of that that's immature, meaning to say there are a huge potential in terms of additional revenue that we're actually expecting in the next 3 years. And in terms of numbers, if you're looking at the price of average price of 1,006, which I think is quite conservative as we speak today, it translates to roughly about 32 million additional revenue by 2025, and this number is actually on a per annum basis. So additional 32 million of additional revenue that we actually expected from year 2025 onwards, and from now till 2025, I think it's progressive. It will be a progressive additional revenue that we will actually capture along as we speak. So as you know, the plantation is actually running on a fixed cost kind of basis, i.e. the cost of the plantation is sort of fixed. So this additional revenue will actually means that the margin will actually continue. We'll just go into the PBT after minusing the fixed cost on a year-on-year basis, and that has not actually taken into account if there's any potential if the market actually rally above 1,006. So I think that's one of the big I will say one of the big potential that we are seeing in the plantation. And on the right hand side, on digitalization, as I mentioned earlier, so what we have a platform called Hibi Connect, which we actually set up back in 2018. And what we do, we have actually partnered with DBS, Itochu, and most recently SGX. And there's also a teaser that I probably can actually share with you, that we are also actually looking at some partnership with a new investor that's going to come into this platform to help with digitalizing the transactions that we do in this platform, this digital platform. So what this digital platform actually allows us to do is to enable the producer like us and also the tire majors to trade on a platform that can capture the physical price, where today where it is traded, it is a very manual basis, and it's also make reference to a future price that's not so much reflective of physical transactions price. So this platform allowed that allow the data to be captured and allow more transparent of physical rubber trading prices indexes that will be generated from this platform and serve the industry better benchmark, I would say, in terms of what the price that it should reflect, basically based on supply and demand, because it's actually tagged against physical trading instead of where we are today, is where it is actually referenced to a future price that's quoted in SICOM. So yeah, and also we're also promoting the sustainability trading of the rubber in this digital platform, and that definitely will that's actually definitely one more trend that we are seeing in the future. Yeah, so moving on next on key financial highlights, I would like to share with you some of the numbers in terms of the volume. I've seen 2020 and 21 volume actually increased healthily about 16%. Price also increased by about 24%, and that's in line with what we are seeing in terms of general price trend. Gross profit actually increased very significantly, about 60%, and that's the reason behind that is because we started with a low base in 2020, where it is probably the mid of the peak of COVID. So we actually rebounded back better than pre-COVID level to record a GP of about 160 million. In terms of operating profit, it reverses the last year loss recorded at 36.1 million for this year, for 2021 as compared to last year loss. EBITDA also actually improved very significantly to 52.4 million, and that translates to a net profit of 70 million, reverses from the loss that we actually recorded in 2020. Whereas if you look at this Q1 comparison based on what we based on the announcements that we made earlier in May, volume also actually increases. This basically I would say a more normalized kind of a trend. 2021 is where we actually get off COVID. So in a period-to-period comparison, we still see a growth of 5.2% higher than what the industry average of 3%. Whereas on average selling price is also trending higher at 1,009 as compared to 2021. GP also improved by about 21%, OP at 7.5 million, and EBITDA at 15 million. So I think in terms of these key financials, they are actually moving in a very good direction as what we expected. And yeah, so this is basically some of the key some of the statistics graph in terms of the volume. From a group perspective, you can see in 2018 it actually gone down to about 2,000 from 1.4 million metric ton. It actually go down to about 1.18 in 2020 during COVID, and it now bounded back to 1.37. That's pre-COVID level, and we actually expected this number to be higher in 2022. Q1, I explained that earlier. In terms of EBITDA, also we can see the evolution of EBITDA that is actually getting better now from 2018 to 2021. And Q1, we are also seeing that slight improvement in the overall EBITDA from 14.3 million to 15.1 million. Next, if I were to go into the two business segment, from a HRC perspective, where we actually sell to the tire majors, the volume actually increased quite substantially from 2020 to 21, from 800,000 to a million. And in Q1, Q2, we are also seeing the increase also, even after COVID. From a GP perspective, we are also seeing a very healthy trend from 2018 to 2021. Q1 2021 2022 is also moving in a positive direction, and I think this is basically one of the major profit driver, I would say major revenue driver that we have in the group, and they are actually moving in the directions that we actually expected, and we continue to expect this to grow further during the year. Moving next, CMC, there are two parts of CMC. One is CMCI. This is basically the distribution business. Later, I'll speak about the plantation business. So the CMC international business is basically a distribution business that is focused in the Europe and US. And we can see the sales volume doesn't actually change very much, but it's still back to roughly about pre-COVID level. The reason for that is simply because the logistic log jam in the other part of the world, in Europe and US, is actually more serious as this part of the world. And having said that, the margin, because of that, actually gives us the advantage of our storage, our logistic network in Europe and US to serve our customer better. And as such, we are able to actually capture better margin. You can see from sales volume, although it actually did not actually move very much, but our profit margin have actually increased 2-3 folds from 2020 to 2021. And even in 2021 itself, compared to 2022, in the first quarter, we also seeing a very huge jump in terms of the profit margin. So that is something that we actually expected to continue. It may probably slow down, but we don't see that it will slow down very soon, as the logistic problems remains as of today. Yeah. So moving on next on the plantation. So this is what I'm trying to actually explain earlier in terms of the plantation. We have roughly about half of that's immature, right? And in terms of plantation yield today, we are actually in 2021, we are actually yielding about 20,000 ton, and that number's going to go up to 40,000 ton in 2025. And that will sort of give a boost in terms of total revenue, and also minusing the fixed cost, that will give a huge boost in terms of net profit, GP net profit for the group. So we actually expected the plantation to get better and better, because the yield is getting healthier and I won't say healthier and healthier. It's just that because the gestation period is now towards the tail end, and we're expecting more new tapping to actually commence, or we have actually started some the commence of new tapping since 2019 and 20, and it will progressively still we are still opening up about 1,500 hectares to 2,000 hectares a year from now until 2024-25. So that has a very positive contribution in terms of the bottom line. And on the capex, from a plantation capex perspective, we expect that to actually slow down, because as the tree gone more and more matured, the required amount of capex to plant for new tree will reduce, and what we'll need is basically the general maintenance of the tree when it turns mature. Yeah, so this just give you a pictorial view of the yield that we expected from a plantation in 2025, 2030, where it goes. And as unit cost is actually lower, as the yield is actually increases, profit definitely will be higher, right? So to sum up, probably I think the next page basically that sums up the proposition, and also it captures the 5 priorities that we're actually working on today, or since the last 1 or 2 years.